Thank you, Aditya, and very good to meet you, Ashish and Amar. Hi again, Shobhit. How are you doing? So we could not start without you, okay? There's just no way we
Thank
can
you.
start without consultants, okay? I was one. I know you are one. So,
Thank you.
and
Apologies, I was out of town, so
no problem, no
jumping
problem.
meetings.
You have some very
But yeah,
interesting window at the back, but we shall keep that for after the session. I hope you're not dialing in from a holiday. But
no, no,
let's
no,
get
no.
started. Let's get started. So as I sort of said, my background is consulting more on the institutional pension funds and overall. And but you come from a consulting side specifically on real estate, first JLL and now with Anarock. So let me start with, I guess, the very big picture, which is basically over the last 15 odd years that I've been coming to India, I've seen a transformation in terms of how people view real estate. Gone are the days where
Mm.
people only buy an apartment, maybe a shop, maybe a strata office. That was the extent to which reasonably well off, middle class and reasonably well off people bought real estate. Now I see many, many more things being discussed. So maybe perhaps you could give us a very big picture overview of how Indians have sort of changed the way they invest in real estate and what all is available to them.
Very interesting question. I didn't see this coming, but you're right. From almost 17, 18 years ago to today, the landscape has completely changed. And the trigger for this was the FDI policy being announced in 2005, and then at the end of UPA 1, which allowed dollar-denominated money to come in and start getting invested in what we would call as institutionalization of Indian real estate. It's been close to 17 years since the first dollar really came in, and over so many years now, almost 2 decades, uh, plenty of money, I would say about $35 billion above, has come in. And what it has done is started to build out in a small way and then eventually scale it to a large number, build out very good quality offices, warehouse, retail malls, etc. Right, especially the yielding sides of real estate, and then even gravitated that to the Indian stock market. That means you now no need to buy. You don't for a HNI, the middle class, in the upper middle class. You don't need to buy physical real estate. You can just buy a piece of it by participating in the list co or the REIT co, which is already listed. So from all the trouble of buying it, managing it, and then leasing it and selling it, right? All that has gone out of window because now you can simply on a click of button buy institutional quality real estate to whatever pocket it allows. So it means I think $300 a piece to whatever else you like. So you can invest as little as $300 and as much as you like. So that's completely changed the way we think and consume real estate for investment purposes. Over and above, in the last 5 decades, 5 years, and especially during COVID, I think people adopted digital quite quickly. So we've got now digital platforms set up for fractionalizing Indian real estate. This includes fractional ownership of yielding assets, fractional ownership of loans, and Ashish is better placed to talk about it. uh, so several opportunities. It's not the grandpa thing saying go to the market, talk to a broker, buy a piece of real estate, right? Hunt, lease. So all that trouble is out, right? And fortunately, unfortunately, nobody is investing in residential anymore. I think people are using it or buying it only for self consumption. As a result, even that asset class has matured a lot in terms of both quality and moderation of quantity. I won't say that quantity is over the roof. So I think we're starting to build as much as we want to eat or consume. So we're not running faster than demand. So I think that's a great thing. So both resi and yielding play, I think, are getting balanced out, and we are just seeing a beginning of upcycle after a very long, slow correction. uh, during which all these changes happened. So I think in future you'll see more digitization, more digital play, more listed play, and so on and so forth. So I think it's changed forever. I mean, this change is going to stay. That's all I wanted to say.
Great.
So Hansi,
Great.
back to you.
Thanks, Shobhit. So there's a bunch of things that you mentioned there. One is obviously the overseas money coming in. So they are the more institutional investors because there's a dearth of domestic institutional investors, I guess. So that's one. The financialization, as you said, is another theme that is playing out. And with both of these, I guess, comes the standardization of jargon, of nomenclature. So in terms of when you say grade A, it's rare that I've actually seen it in the literature in terms of defining real estate in terms of grade A, grade B, grade C, or retail and even also on the risk spectrum from core plus, opportunistic, value add, and so on. So I think hopefully that will happen.
That's
But
right.
with that background, let me sort of switch to Amar. You represent a group, IIFL Wealth, which has sort of the wealth side representing HNI investors as well as on the asset management side that you represent. What sort of themes are you seeing playing out in terms of what investors are asking for and what the supply or the intermediation of real estate is allowing people to offer in terms of supply?
Yeah, thank you, Hansi. Good to be here. So I'll just take on from what Shobhit has said and quite relevant themes that were put out. So if we look at where we are and where we started out from in 2000, let's say 3 onwards, when the overall markets and the overall economy and emerging markets started moving up, real estate opened just a couple of years later, and we saw a huge amount of liquidity coming into the country, which helped generate jobs, which helped generate a lot of interest around real estate as Press Note 2 came in 2005. And then onwards, we have seen the sector getting organized a bit more, quite a bit more, better governance, better practices, better quality assets, and range of offerings on the financial side, which make it far more sophisticated as compared to where it was 15, 20 years back. So let's say if I would talk about 2002, which is 20 years back, a 50 crore loan to a developer would have looked amazing. Wow. Today, nobody even cares about it. So in the last 20 years, and that also would have been to the absolute top grade developers, maybe 2 to 3 in every city. 1 or 2 banks will be doing it apart from HDFC Limited. That's it. So in the last 20 years, we have not just seen loans expanding hugely. We've seen it coming from HFCs and NBFCs and funds now. We have seen REITs, we have seen InvITs, we have seen mezzanine structures, we have seen cash flow, first charge, second charge structures, we have seen distressed funding, inventory funding, pre-approval funding, post-approval funding, everything. And it's not much, it's what, 18 years since all this started. So which makes us feel that this is only the beginning. There's a far bigger play on real estate that is expected in the next 5 years, leave alone the next 10 years, but even the next 5 years, because of the following reasons. Number one, we are far more organized, matured, and much stronger hands, both in terms of developers and finance providers, compared to where it was pre-2018, because of the NBFC crisis and all whatever happened. So it's much stronger and more capable and bigger hands. Number two, the practices that developers and financiers used to employ earlier have changed significantly. Far more mature, calibrated, aware of the risks, aware of the returns, aware of the bounds, and the potential upsides and downsides. The unbridled greed or fear is not much there any longer, and therefore it's far more mature from that perspective also. Third, as far as foreign capital is concerned, we are still pretty small in the overall context. We get somewhere between 5 to 6 billion a year, and we seem to be happy with it. But in the overall context, it's extremely low. Every year you have about $1.1 to $1.2 trillion of money coming into real estate globally. of which we get 5 to 6 billion, which is not even 0.5%. For a country like India to get 0.5% is minuscule. We need much more, we deserve much more, and I'm sure we'll get much more given that 1 and 2 have happened. So all I'm trying to say is that there is grounds for a significant increase in the potential of money flow into this sector, and not just from international sources, but even domestic sources. Because if you look at it from the domestic segment, options that wealthy investors and all classes of investors have, apart from the capital markets, there is real estate, there is of course non-real estate credit, and private equity. Now each of these segments has seen a fair bit of activity in the last few years. If you look at the stock markets, if you look at how they've increased in the entire COVID period, doubled more or less and then come down a bit. Private equity valuations, where they are, seem to be a bit under a spot of bother. Whether it gets more money from here incrementally in the same pace as what it got in the last few years, doubtful. Credit seems to be good, interesting. Both real estate as well as non-real estate seems interesting. But on the whole, if you look at it, real estate has not seen this kind of interest and momentum as what we are seeing now after a long period of time. We've had a lot of industry defining events like RERA, GST, demonetization 2016, NBFC crisis, and then COVID. And now finally we are up and running. Developers and financiers know what we want from each other, and number of people who provide capital as well as number of people who are availing of capital are limited, and therefore the degree of understanding each other is much higher at this point in time. If you come to the present juncture as to where we stand today, and then we'll come to the kind of investor interest and appetite. At the present juncture, look at each of the aspects from a developer point of view and compare it with the last 1.5 years. If you look at sales, developers enjoyed a purple patch, fantastic time in the last year, 1.5 years, where there was a huge amount of pent-up demand, low interest rates, wealth effect, a lot of fence sitters earlier who did not buy, and therefore we saw a lot of sales in many cities across segments, highest ticket to the mid-range market. There were a good amount of sales in residential. So therefore selling was easy. Now, because interest rates, we saw today interest rates have gone up again, 1.4% increase in the last 4 months, and wealth effect wearing off a bit. Stock markets are where they are, precariously poised perhaps. And therefore it's not, the momentum doesn't look like sustaining at that level. It will be better obviously compared to pre-COVID, but still it's not the last 1 year of the burst of sales that we saw. So it will be challenging to sell going forward, especially if prices are increased. Second, if you look at construction, commodity prices having gone up, steel, cement, labor gone up. Therefore, will construction costs, margins, will it be easy from developers' point of view? Not so easy. Therefore, again, a challenge. Finance costs have gone up, number of lenders have come down, and therefore, even obtaining finance at the right terms will be a challenge. Therefore, developers will have to innovate. Technology will have to be used, whether it be whatever it is, could be VR, could be AR, could be IoT, could be 5G, could be many of these practices together, could be digital marketing. Everything will have to be done. Property technology will have to be harnessed. Many more facets of technology will have to be bundled together so that productivity goes up as well as costs are mitigated and customers are obtained at as easy terms as it was in the last 1 to 2 years. So therefore, these challenges will have to be met by advancements in technology and better processes and governance, which we are on the way to do. As far as investor interest is concerned, definitely high, both in yielding assets, which is REITs, as well as in credit, which is funding to developers, provided of course it is good developers, leverage under control, approval risk significantly mitigated. There is enough and more interest now as compared to what it was earlier. In fact, a lot more than what I would have thought in the last 6 months back. So, so that is what I would like to say at this point. And yeah, we look forward to doing far more in this market, in real estate, and hope to see that happening over the next 2 to 3 quarters.
Right. Okay. Thank you. Thanks, Amar. One thing that comes to mind, and again, having put my old Mercer hat on, other asset classes, I could still consider India, but real estate is one of those where the reputation of the prevalence of black money and the issues with land titles or not having clear titles and things like that that come to mind that may put off some overseas investors, I would have thought. But coming back to your question, sorry, you said 5-6 billion. I mean, how much do you expect? What do you think we deserve, and what do we need? Do we need foreign capital in real estate? We might need it in venture capital and a whole bunch of other asset classes, but why do we need foreign capital in real estate?
Oh, of course. See, foreign capital is not just from the money point of view, but also from the point of better processes, better technologies, because when capital comes from a responsible financial institution based, let's say in the US or Japan or wherever it is, it comes with a huge amount of experience behind it of managing that capital with better processes and technology that need to be adopted by the deployed by the developers over here. And therefore, it's not just money, but also a lot of other things associated with it. As far as the amount is concerned, 5 to 6 billion in a country of 135 crores and urbanization increasing and a huge middle class expanding across segments, office, warehousing, residential, and now data centers, hospitality, retail malls. It's too low. At 0.1% of the global capital coming to India, it's abysmally low. We need definitely far more, and with infrastructure development now taking place across many cities, metro programs coming up, and better connectivity to the outskirts of these cities, there will be a lot of development that takes place, which may not be amenable to just domestic capital, because the tenor of capital is limited in the domestic segment as compared to the offshore segment, both for infra and for real estate. And therefore, both types of capital is needed, not just domestic capital. Therefore, there's a strong need for offshore and domestic. Yeah.
Right, right. Thank you. Infrastructure, I totally understand. And I take your point about real estate as well. Some of these innovations that you mentioned, or some of these changes you've mentioned, both Shobhit and you, in terms of, for example, REITs. REITs, I mean, I did my whole career in Australia, and REITs existed in Australia 30 years ago. So it had nothing to do with digitalization or necessarily an innovation. It's a very simple financialization and listing on the stock market. But let me turn to what has sort of truly transformed. Ashish, if I could turn to you, and you also, I looked you up, you have a background in KKR, so maybe sort of pick up on Amar's point as well in terms of what innovations are we seeing in the Indian market, both something that we have brought from overseas and more, and some that perhaps we have come up with just because we are at a point where the internet and just generally digitalization is there. We are as much as at the forefront as anyone else. So what are we seeing in terms of digital platforms or any other type of innovations in the Indian market today? You're on mute.
One sec, yeah. So, no, I think that's a very relevant point, and all this innovation, I think, is fairly new. In the West, it has been happening. And in the West, the financialization, as you yourself just mentioned, started 30, 40 years back. So whatever digital is doing is a new form of financialization, and making it a lot more accessible, making it a bit easier for many other people to understand. Like, while REIT and fractional ownership fundamentally is no different, you're fractionalizing asset. REITs are being able to fractionalize very high quality, very well managed assets. Fractional ownership less so, but easier to understand fractional ownership than REITs, right? So I mean, I will just rewind a little bit based on what Amar was saying, and this whole contrast between foreign capital and domestic capital. And in fact, all my life I've actually been with Morgan Stanley KKR, always deployed foreign capital. It is last 4 years since we started on our own. And at this point in time, we're as much dealing with foreign capital, which is what we have been doing for the last 4 years. And for the last 1.5 years, we're actually also dealing with a lot of domestic capital. And in fact, My feeling is that while we absolutely have the opportunity to attract a lot more foreign capital, in fact, the participation of domestic capital is actually abysmal. And our problems needs to get solved a lot more by domestic capital than by foreign capital. India is not at any point in time going to get cheap foreign capital for development. India, even today, at about 300 million square feet, and this I am talking about only tier 1 cities, right? So out of that 300 million square feet, your 200 million is residential, your about 40 odd million is commercial, your warehousing, I don't know the exact numbers, but probably another 40, 50 million, but in terms of value, it ends up being much lesser, and so on and so forth. So you would see that a lot of, so foreign capital has been very good at buying assets, or actually at supporting some of the more easier to construct, like especially warehousing as a platform, that kind of thing. But your 200 odd million square feet of residential, I don't think foreign capital over the last 15 years, or at least since GFC, has done much on that. Very, very limited. It is happening last 2.5 years, and the credit bit on that has been very good. So that's happening. But we firmly believe that a lot of that will have to come from domestic. And I think Amar pointed to that, that the interest in credit at this point in time is quite high, right? So that's kind of important. But coming back to your larger question, so what these new things are doing now? So one, the interest of it. So a lot of these things, first of all, they are focused on domestic capital. In fact, a lot of audience that probably we are talking to, which is on the Aditya's platform, is actually domestic capital. They are either investors themselves, they're looking to advise their investors as to how they can touch upon real estate as an asset class in a somewhat different way, right? Today, still, despite everything, I think if there are 100 rupees invested in real estate by domestic guys, I think 99 are still in the physical form only. REITs, a 2019 phenomenon, I think is just about catching up. People are starting to get a good hang of it and starting to feel as to how that works. I think your single family offices, multi-family offices probably understood that the first, and they really love it now. And slowly the broader, maybe some mutual funds and all that's kind of percolating. And then now, last 3-4 years now, with the digital platforms now coming in. So a lot of platforms have already come on the fractional side. We are actually building something which is actually a lot more on the credit side. Personally, our feeling remains that on the fractional, I think nothing beats REITs if you can understand that. They're the best kind of fractionalization in commercial real estate you can get, right? But yes, different investors will have different things. On the other hand, getting good quality credit. I mean, I was in KKR, we were running a book, that book has done okay. But personally, I could never get that 15% return. So why should I only make 5%? Why can't I make 15% as an individual, right? And that has been a little bit of the thought process. But again, in all these digital platforms, most importantly, I think more than they being tech platforms, they have to have core investing DNA. And if I am the investor, I mean, the first thing that I must look at is what is that? Because at the end of the day, what I sell on the platform is only as good as the platform can produce it. So in a nutshell, I think this will certainly proliferate. And this one analogy we have used in other situation also, if we go back, I mean, one of the way to compare it is 25 years ago, when mutual funds just about started, everybody used to invest into equities in a haphazard manner. Tips, everybody will do direct, no seasoned managers, this, that, etc. Participation was limited, and of course, the experience was generally very bad. Out of 100, maybe 2 people will make money out of that. With now this 25 years of history of mutual fund, I mean, we just see where things are. I mean, it's different. So today, all real estate, actually, there is no manager to it for the domestic guy. If you're buying your own land, if you're buying your own office, if you're buying your own flat or whatever you're doing, you are just doing it as the best of your own judgment. And I think these digital platforms, REIT is already a avenue which started about 3 years back. All these digital platforms which do well, which are able to create that sensibility of having an investing DNA, should be able to do that for the Indian consumer and Indian investor. That's how I think it should go.
Okay, so by digital platforms, you simply mean the securitization of real estate, right? That's all what we can do. So whether it's through REITs, whether it's through REITs or whether it's through fractional, in the end, all you're doing is taking a big building that's worth 1,000 crores or whatever it is, 5,000 crores, and breaking it up into smaller pieces and selling it to retail investors or HNI investors, right? Is that what you're saying?
So that's exactly what financialization is. Now, how that financialization is being delivered to an investor is taking different forms. So your REITs, which is the most regulated form, and therefore you can just do it on a stock exchange, is kind of now there, and that's happening. That's where you're doing really big buildings, really institutional quality asset class, right? The digital platforms right now are operating in a smaller space, right? I mean, to give you an example of what we are doing on our own thing, of course, I mean, in a typical way, okay, you will take $10 million loans, fractionalize those, which people can invest. But again, you're doing very simple. Like today, you're used to going and buying a Power Finance Corporation bond or an HDFC bond or whatever. They're already AAA rated bonds, right? Which you always had access to. Now these things are allowing you to invest into things which are otherwise probably regulatorily the same, but they offer different yields and different risks. And where you need to communicate that risk very properly, nobody is getting any free return on anything, but it's just that you're getting the benefit of that managed risk, right? So I think the only differentiation I do want to bring about is that most people, even today, when they think of benefiting from fractionalized real estate, generally it comes to the property, and that you can buy a piece of that property using a digital platform or using a REIT. But I think there are many, many different avenues, credit being one of them, which I think is a much larger space overall versus just the strata office buildings.
Right. Okay, I will come back to some of these sub-asset classes in a bit. But one question that Amar and Shobhit, you mentioned is domestic investors. I'm just curious, which domestic investors have you not got? I mean, I only see HNIs being, I mean, middle class invest in residential. Okay, we barely can pay our own apartments in our lifetime. Most of the Indian population basically barely manages to pay off their house. They don't have the extra money. So it's basically HNIs, whether you call it a single family office or whether you call it HNI via the private banking sort of channel. They are pretty much it. There are no domestic institutional investors. We have no pension funds, and would insurance sort of investors actually consider real estate? Would they even do that? So I'm just asking, I mean, are we sort of hoping that there'll be a domestic sort of investor class, or do we have to really pitch overseas only?
So domestic includes exactly what you've said. It also includes family offices, which is effectively ultra HNIs and their investments. It also includes corporates and their treasuries. It also includes financial institutions in India.
But corporates, I would have thought, would keep very short-term money, right? I mean, they surely would be better placed, in fact, buying businesses that give much higher ROE to their business rather than buying real estate. If in fact, my question would be the opposite. Isn't there a whole bunch of real estate sitting on corporate balance sheets that should be offloaded and put into REITs so that it can be picked up by retirees and retail investors who want yield plays? So I'm just saying, is corporate a buyer of real estate or are they a seller of real estate?
Both. So there would be corporates who would do buying, there would be corporates who would try to do selling. But again, looking at the three listed REITs and the quest for absolute grade A plus real estate, I'm not sure how many assets would actually qualify at this point in time. But yeah, when the market deepens and we have more assets coming on stream of various types, various asset classes, I'm sure what you're saying also will happen eventually. But at this point in time, it's these 3-4 segments that is effectively domestic investors, and we are seeing pretty strong momentum at this point. Again, which wasn't there 6 months back. Both on the yield play, which is REIT oriented, even willingness to go into private, non-listed, and then maybe getting the listing pop, or private credit into real estate. Again, decent developers looking at various markets, could be the IT growth cities of the country like Chennai, Bangalore, Hyderabad, Pune, Noida, Gurgaon, or even Bombay, the redevelopment play. So all these aspects is what the HNIs, ultra HNIs, and their family offices are well aware of, and significant amount of capital is coming in.
Okay.
So Hansi, if I were to just add to that, you made the right point. So domestic institutional investing in India is actually pretty bad. I mean, in the sense, most people are regulated. They are not allowed. Insurance companies can buy buildings, but they can't buy a company which owns a building, which is how a lot of buildings actually trade, right? So there is a huge issue around that, and also therefore actually domestic capital. When we think of it, it's less institutional. It is more individual or personal capital, really, right? If it is credit, then of course financial institutions can participate. But if it is not credit, then many financial institutions can't.
Right.
So that's exactly where I think this difference is, that today, till date, it has been only HNIs or ultra HNIs, because they have to buy these large chunks of property, whether land, office, warehouse, whatever they're buying. Now, if this financialization and fractionalization and bite-sized credit can change that, interest of a 10 lakh rupee guy is as much there. It just says that he has never had the opportunity. So let's see how much they will participate.
And one other point which I would like to also highlight is that I would actually define it as pre-2018 and post-2018 because of the NBFC and HFC crisis. So post 2018-19, the entire NBFC, HFC appetite for real estate investments has shrunk steadily every year. And that entire demand is now effectively being met by funds, offshore funds, onshore funds, domestic and offshore. And that is the huge potential that investors also realize now, that this market is significantly better in quality assets as compared to what it was till 2018. There's a fair bit of realization on that also. That's coming in.
Right. Okay. Okay. So let's jump into more of these digital platforms. Where does the skill and the risk come from? Assuming that the underlying asset class and the underlying asset can't change, right? I mean, a building is a building is a building. So now the question is, if there's a return that someone is advertising that is 10% plus or 15% or whatever the number is, then somewhere the risk return has been redistributed. Okay. And I'm curious also, one, how is that risk return being redistributed? And two, what skill set should a private wealth firm or an advisor or an investor for that matter look for when evaluating these platforms? So where is the skill being added? And therefore, as if I'm evaluating some of you, what should I focus on? Ashish, perhaps you should go first, and then Shobhit, I would love to hear your thoughts as well.
No, I think that's absolutely the right question, because a lot of platforms get positioned on the strength of their tech or how the look and feel is or what it is or how the convenience is. And I think all of that is extremely important, because people are looking for an experience, ease, transparency. To my mind, there are two most fundamental things. If I am investing my own money through any of these platforms, there are basic two things I'm really looking at. First and foremost is, what's the underlying team? Have they done it? Have they not? I mean, I can go to a best looking mutual fund house, but if the team has never really done investing, I should be wary. So first and foremost is how good is the team, and is the team is there skin in the game, which also in many platforms remains a question, right? Like in many, at least in your typical private equity, etc., there is a fair bit of a skin in the game concept. Most LPs would want to look at it. These platforms don't have to really offer that, but if that's being done, I think it's a good hygiene factor to look into. I think first is really like, you will evaluate if you have a good advisor, he should be digging deep into the team's qualification, the team's experience, the team's track record, right? Goes without, if there is no difference than looking at any other financial product.
So just on that, what qualification? I mean, given that unlike other sort of thing, I mean, what qualification should I be looking for?
I mean, it's like if Amar has been doing real estate credit for 20 years, and if Amar is driving that platform, I think there is some comfort that he will do the right thing. And he has gone through his own cycles, and he has seen it. He has seen the good, the bad, the ugly, and he will make the right choices.
Yeah, but unlike in listed equities, in listed equities, when you're buying so many stocks and selling so many stocks, even when you make a lot of mistakes, you can learn very, very quickly. The cycles are the turnover is high. The problem with real estate is that the cycle is so lumpy that I bought a building, and if I don't sell it for 5 years, 10 years, I don't even know whether I made a good decision or not, right? It's like venture capital.
Yeah. So that was the problem, Hansi, which when we were all starting, and I think all of us started kind of similar in 2003, 4, 5, and we all had the exact same problem. But I think now you do have people who have been around in the industry doing this for 15 years, having done a bunch of different things, made their own mistakes, some learnings. And I'm sure, I mean, we are still nowhere close to the Western market. So enough and more learning is yet to come. But still, a lot has come. A lot of regulation has come. A lot of cleanliness in the system is happening. So I think it's not that you can't. You can. You just have to start blind. That's not the case.
Right. Right. Shobhit, your thoughts? Like I said, I think a building has a certain yield, whether it's warehouse, industrial being high yield, then retail, then commercial. What other sort of financial engineering or value add can platforms do? And therefore, what risks am I as an investor taking on?
No, so I'll probably just continue from where Ashish left. Like, look, team experience is very important. What kind of team, what kind of experience they come in with. But most important, before I actually just sort of step back a second, saying most of the domestics, and this I want to sort of categorically mention, is playing credit. And all the dollar money that's really coming in, large part of it is going in equity. So if you want India to build 200 million square feet residential and housing for all, you need to do one of the two things. Either you have to allow mutual funds, insurance companies, etc., to participate and set up sovereign. So you have set up sovereign in the form of Swami Fund, but that's only talking about stuck projects and credit risk. So I think there is no option, but you have to do it. Second, if you want dollar money to come in and support the Indian residential market, right, you then have to allow what is called as build to lease, right? Not everybody has to own his own apartment or a house or a bungalow, right? World has shown us everywhere around the world, there are housing that's called rental housing. You build it, it effectively works the same way as an office, and it produces similar yields, 6-7%, and it competes with office, right? In fact, it may be better than office because it's more fractionalized in terms of rents, right? These can be listed, they can be unlisted. So one, we have to deepen our market, both in terms of equity and in terms of for lease or for rent housing. Coming back to your point, saying, what do I look at on digital platform other than experience, is the robustness. How much can you do and how quickly can you do and how quickly can you scale? I don't want to invest in a platform that's investing in 5 deals and then runs out of money, or 6 deals and runs out of money, right? So I need to be sure that any platform that I'm putting money in has scale. If it's subscale, it's going to die naturally, right? So I'm anyways carrying the real estate risk, then I'm carrying the risk of that platform being too small and experimental. So I don't want to be part of any experimental program that's being run. So I think we are still in very nascent stages and this market is still in the test phase. I don't think we have seen anything that's done series B, C, D, is gone out of the test phase. So I think we are very early on digitization as far as fractional ownerships are concerned. I think Ashish can speak a little bit more. I don't know.
I think
Yes.
that's absolutely right, Shobhit. I think that's exactly the thing. And it's a very early market. And yeah, if these platforms don't scale, then they can't continue for a long period of time. And that is where I also feel that this whole skin in the game is important, because especially when you are early on, because if there is skin in the game and if team is involved, and even if the platforms don't scale, at least there is serious money involved from the sponsors to make sure that at least they get that money back and investors don't suffer on that. So yeah, but once they scale to series B, C, it will be different.
So Shobhit, your point is, Shobhit, sorry, go on.
Sorry, and I'd like to add also, I think most of these fractional programs that have been set up are not regulated yet. So there is no regulation around how these operate. I think SEBI has not set out any guidelines. It's still not deemed public. So it is not public, it is not SEBI controlled. So these are just random people trying to, I think the earlier they bring this regulation, the better it will become. Don't allow anything to fail and then say, okay, but you did this and therefore now I'm putting a regulation in. I think we should put it in like we did it in REIT. And you mentioned that you were in Australia 30 years ago and REIT came in. So REIT is not a new product, but India regulated it only in 2017. And after that, 2018, 19 saw the first come in. I'm hoping that you first put the framework for these digital platforms and then allow them to run on it. So I know that somebody is watching over me, right? And these are regulated platforms. So right now they're completely unregulated, free to do what they want. So it's a bit of a risk.
Right.
You are setting them up for failure.
Yeah,
Right.
I think that's also very important. And the good part is, I think regulator is getting focused on this though. So on the fractional ownership, I don't think yet anything has come. But like as recent as 2 weeks back, SEBI has now already come on bond trading platforms. They've issued their first consultation paper, and they've actually taken cognizance of the fact that these platforms are, which is not to do with real estate, but it has just to do with credit. Corporate real estate, it could be anything. So yeah, so I mean, the sooner they create that framework, that's good.
So I was telling you about REITs being there. In fact, REITs were actually the name given later. They were actually LPTs, listed property trusts, which only had yield plays, and there were development companies which were listed just in the normal Australian Stock Exchange. And eventually the two sectors got merged. So it actually became riskier. Whereas here our REITs are pure listed trusts. But one other example that we could learn from, again, this is 30 years ago that I started my career, and I would basically sell what were called retail mortgage funds, which is basically loan against property, right? Most mortgage funds were commercial property, but there was one particular one that was residential. And this guy, the sponsor of this, would go around telling the market that therefore his is less risky because against residential property, where actually the borrowing was for commercial purposes, but against the promoters' homes. As it turned out to be riskier, and it was something that I and my boss backed me up on this. I called partly because I think residential doesn't get valued as rationally as commercial or retail or warehousing. Why? Because individuals own their homes and they think their properties are worth more than everybody else's because they think they have done it better. So I'm just saying to you that residential, I think, my personal view of the last 30 years is residential gets mispriced more often because us humans like owning our properties. So Shobhit, your point about, yes, we should rent, but nobody does what they should. We do what we want. And owning a dream home is, whether it's an Australian, whether it's an American, whether it's an Indian dream, every country says that we are special. So coming back to this mortgage fund and the learning from that, Ashish, I wanted to ask you, you mentioned sort of fixed return from or debt against real estate. That is developing as an asset class or sub-asset class. Looking at, I mean, is it as simply as there's a property and you do a loan to valuation ratio of 70-80% and borrow against it? Is it that? If so, then why are the returns higher? Is it leveraged up? Like, just explain the asset class a little bit more. And then I would love to hear from Amar and Shobhit about investor interest on that, but maybe explain that asset class a bit more.
So I think there are both. So, so Hansi, to clarify, India residential is a dramatically different setup, and in India, 90% of whatever we do is actually primary. So it's not individual selling homes, it's builders selling homes. And that is where over the last 15 years, there has been a fair amount of discipline, both market driven and regulation driven. Regulation because of RERA and GST and all that stuff, and market driven because a lot of riffraff has been cleared off because customers just don't buy. So there, I think you're dealing with a very different thing. You are seeing a history of a project, how much it is selling, what is the price, what is the volume, what is the market and all that. And like any other development, you can actually make a good assessment, if you do it well, of what should be the right kind of lending to it. And because of regulation on the banking sector and various different things, a lot of this space was always filled by non-banks as opposed to the banks. Also, generally speaking, banks are very good. The large banks are good at doing a bit corporate conglomerate lending. I mean, many banks are very good at giving money to big groups and all that stuff, where they're doing more of a name-based lending or drawing comfort from that. But very granular, more fragmented markets of players, they get difficult. That's why that was non-banks. But after the credit crisis of 2018, non-banks are a bit out, which is creating this opportunity, which is what even Amar was referring to, that there's a lot of interest in credit. So when we talk about credit to residential, it is actually not credit against a built residential property. It is against developmental projects that are underway. And therefore it is credit being given. So it is secured because it is secured by the land, the value of the construction that is going on, etc., etc. But there is a development business that is going on under that entity. Okay. Also, there is of course a lot of lending that goes on against commercial assets. But there, that's a different game, and that banks are very good at. And the rates there range anywhere around 7%, 7.5%. So that's very different. When we talk about funding developmental projects, that's where the returns are. Like when I was in KKR, that's exactly what I would do. And we would make returns between 15 to 18%, right? So again, but a lot of mistakes have also been made in doing so. So it is a specialized business, and that's where again the expertise of the team, etc., becomes as important, because you are actually, every city has a different regulation, assessment of the counterparty, market strength. Every micro city also has all micro markets. So so that's kind of what it is. So just wanted to make sure that this distinction comes out in terms of credit to real estate.
Amar, do you have something more to add in terms of this real estate debt asset class, in terms of risks? If it is lending to developers, I would have thought it's very high risk, because it's a sector that has political money, black money, regulation risk, delays that happen in our country all the time. All these things can happen. So how much return should we be asking for? And again, coming back to what should we look at?
I think Ashish has given a good overview on that. And to answer your question specifically, I think the sector real estate debt specifically has matured quite a bit in the last 7-8 years. And I think it's gradually moving towards a more organized business, perhaps getting more and more in the nature of a consumer FMCG gradually. And at least now the differentiation has come in the minds of finance providers on 3-4 things that are important. One is obviously the developer and the counterparty, and who you do business with, obviously important. Second is at what stage do you invest or lend into the property? Pre-approval, post-approval, if pre-approval, which approvals are there, which approvals are missing, and what's the timeline to obtain the approvals? Is the land been fully aggregated? Is there an acquisition risk? Is there a development plan seeking risk? And obviously the final frontier is a RERA approval. So if the RERA approval, is it 6 months away, 9 months away, 1 month away, 2 years away? That is the question that people, sophisticated lenders do ask. And then after that, obviously the more basic but essential aspects from the developer point of view, which is execution capabilities, which is sales and marketing and CRM capabilities, which is people and corporate governance practices, talent retention at the developer end. And what we've seen in the last few years is consolidation play out to a large extent, and therefore many of the mid and smaller size developers, may not be all, but yeah, quite a few of them, especially those who were over leveraged and did not follow good governance practices, they have been marginalized. There are some smaller ones and mid-sized ones who are doing very well also, but those are the ones who have stuck to good practices, managed to keep their debt low, managed to have things under control on all the fronts, and they are the ones also who are coexisting along with the larger ones in the new scheme of things. So from a lender and a credit point of view, I think stage of investment, nature of the project, earlier people would look at large townships, SEZs, 100, 500, 1,000 acres. Now, if it is more than 10, 15 acres, seems to be difficult to be done in the next 3 to 5 years, raises red flags. That itself will be, I think, enough for next 3 to 5 years. So visible, doable projects, no major ambitions on getting things approved which are out of the ordinary. Return expectations also are not in their 20s as was earlier. Now it is high teens. And when I said high teens, and I talk to developers at high teens, They come to 15, 16, and then I tell them high teens is not 15, 16. So then I say young adult, which is 18, 19. So nowadays I call it young adult pricing. And therefore, that's the kind of pricing for perhaps land acquisition, perhaps pre-approval to small extent, largely approvals in the picture. And that is attractive from a HNI and family office point of view, because at that kind of yields, there is a strong level of interest in real estate residential debt, which also is attracting a lot of investor interest, because a lot of these developers in the last 2 to 3 years, the good guys, say top 5 to 7 in every city, have deleveraged quite a bit. They have had huge amount of sales because of COVID hiring in these IT cities. They have had consolidation activity, therefore the smaller developers are not as active, and they've been able to sell and collect well. So these are the guys who are buying lands today, and this kind of pricing. So makes sense from investor point of view also.
Right. Okay. So in closing, as I said a couple of times, I used to be Mercer. I have friends still there. I have friends in other sort of consulting firms and some endowments, some family offices. So imagine I take Indian real estate as an asset class to these investors. What is your 2-minute pitch, one at a time? What should I go and tell these overseas investors about why they should be investing in Indian real estate and which particular segment they should be investing in? Shobhit, perhaps you can start first.
Yeah, my answer, if I'm taking this to global investors, will be still office, because of familiarity of the tenants, familiarity with buildings. They're very similar. India has the largest stock of green buildings anywhere in the world. So we are building beautiful buildings. You've got it right. And efficiency of capital in terms of deployment, how you can bring it in, how you can take it out, taxation, etc., is all been beaten to death and streamlined. So you don't
and
have
what
to
returns would I get? What returns would I get?
You would get
currency adjusted, please.
Currency adjusted, I will answer subsequently, but you will get income plus capital gains included about 15-16% rupee return. If you adjust for dollar, you can shave off 4% to 5%. So you'll get, say, 10-11% dollar return. And you'll get it consistently. So this is a sustainable return profile and not opportunistic.
Right. So that's your bet. You would pitch safe commercial real estate to overseas investors. Thank you very much. Right. Amar, what is your pitch?
So I think there are different classes of investors, different tenors and risk thresholds. So obviously the more acceptable bet would be commercial and possibly even warehousing. So income generating, predictable yields, predictable cash flows, good quality assets, and great tenants to showcase. No doubt on that. And yeah, 15 to 17% par for the course, pre-tax, pre-everything, pre-currency, and yeah, so pretty much on the lines, but on the lines of what Shobhit said. But in addition to that, there's the vacuum that I'm seeing in real estate residential debt. It reminds me of 2009, 10, 11, because this is what I would do then. There were hardly any capital, fantastic transactions in the market, very less competition from a capital point of view, and good developers to deal with. The problem started from 2015, 16 post demonetization, because mutual funds started lending to NBFCs, and that is when the huge amount of capital came in. But from 11 to 15 was a pretty good run from the earlier cycle point of view. And I see similar with a larger outlay of funds and better developers now for the next 4 to 5 years. Therefore, I would actually I would prefer real estate residential debt if there are investors, and there are, who are interested in it for the next 3 to 5 years, in addition to the pure play commercial.
And would that solve that whole urbanization gap problem that McKinsey highlighted in its very famous report about a gap of 25 million units and stuff like that? Would that solve that?
I think that's more a overall socio-economic and overall urbanization. That may be a longer time frame, but from an investor point of view, I think we're talking about the top 5 to 7 cities only, and not the larger tier 2, tier 3 market, which also is a different market, attractive, but I'm not talking about that.
I've come in to support Amar. I don't think the straight answer to your question is it won't solve that, but I think you start to bridge that gap, because to solve for 25 million dwelling units will take you at least a decade or maybe more. So you to see the change will take you time, but directionally we'll be in the same.
It may be one more step, but we are talking about commercial returns for investors, and therefore I would prefer the top 5 to 7 cities for this. Next 3 to 5 years is a good runway. So definitely yes on that. And the third is equity partnerships with developers. Very good developers, maybe top 2, top 3 in each city. There's a dearth of equity capital at the project level, not at the company level, but at the project level, platform level transactions. A lot of them have taken place in commercial real estate, office real estate, not so much in residential. Right. That is the next big opportunity also. Right. Perhaps in the next 1 2 years, that should be the next one. Right.
So Shobhit and Amar have been very traditional. Ashish, I'm expecting a very innovative answer. Okay, so where are the innovative platforms that we promised investors? Okay, so what are we talking about? So where should they invest?
See, I think so. 2 parts. So if you actually think of institutional investors into real estate, I will actually pick both on what Shobhit and Amar has said, but in a very today also.
No diversity of opinion. Like you should disagree with each other.
No, I'm not. I'm going to disagree with them in a certain way. Okay. Point is, what Shobhit is saying that has been playing out for the last 15 years. The credit has been on a roll for foreign institutional investors for the last 4 years, especially since 2018. January 2019 is when it started. But these are completely distinct investors. You have the Blackstones, GICs, Ivanhoe Cambridges, and Brookfields of the world that has stuck to buying assets, whether warehousing, office, retail, whatever, yielding assets. And you have the likes of Oaktree, Cerberus, Estilo, and a host of them. Apollo. Apollo deployed almost $1 billion last year in residential credit, with a similar kind of a game being looked at today. So you have both these investors as interested in both these asset classes very clearly. And because the fact remains that India is still a build-out country. I mean, you can keep doing this consistently in office because India still creates 40 million of new office every year. If you don't have it, then it just becomes trading between these counterparties themselves. So point number 1, there is appetite among foreign institutional investors for both of these things. The thing is, in India, the largest of asset managers, actually, it has not been blind pool or pooled vehicles. It has been special managed accounts. So HDFC has a special managed account that is for credit also. Kotak has a special managed account that is for assets also and credit also, but they are special managed accounts. If I, as an asset manager, can actually get to say, let me construct a portfolio for you. At this juncture, I would say 50% office or yielding assets and 50% credit, because the vintage of credit is very good. And again, I mean, in investing, it is all a vintage game. Today, the credit vintage is very, very good because residential is on the uptick and capital is not there. On the other hand, warehousing, where operationally it is doing fantastically, there is a wall of capital chasing. I mean, I was at the Camden conference, which is a family office conference, and I'm taking a slightly different example. A mutual fund manager gave a very good example. He said at the height of .com boom, 2000, Wipro had a certain stock price. And Wipro from 2000 to 2008 did extremely well operationally. But the stock price didn't move because it took 8 years for the 2000 stock price to catch up to 2008. So what we are seeing today is certain themes which are loved globally, industrial and warehousing being one of them, have enormous allocation, but extremely difficult to deploy that much capital. On the other hand, you have other themes which are not as well accepted and a little bit more difficult, or their past experience has not been as great. But they're standing at a fantastic vintage, but they're not getting as much allocation. So if we leave it to the domestic experts and who are living, breathing this on a daily basis, they can construct a portfolio. Life is generally not that easy or fair. So people will make their choices and they'll give you the mandate that they want to give you. But if I can get a mandate and then I have the choice to allocate the way I would want, I would do this 50-50 because it does provide a certain amount of stability and familiarity, which also you need to service to an investor, but at the same time benefit from where our vintages are.
Great. Thank you very much. Shobhit, Amar, do you disagree with Ashish? Just in case, I'm giving you the last word.
I agree to disagree. I'll save it for later. But no, I'm more or
I
less.
love stirring the pot. That's great.
I'm more or less going to agree with Ashish saying a balanced portfolio is nice. I'm not sure whether 50-50 is right, but some kind of a balance between purchasing assets and yielding assets versus credit side.
Okay, great. Thank you. Amar? You happy? You're mute.
Let me just unmute. Yeah. So basically, I think real estate, unlike let's say equity investing, is largely bottoms up, and therefore it is specific to that asset, specific to that location, asset, and micro market, and therefore this percentage of 50-50 can be different across years, across cities, across the kind of transactions that one looks at. So may not be as clear, but yeah, I think overall pretty okay. It also depends on the stage of the cycle globally we are in. Are the risk off, risk on, interest rates moving up, down? That impacts this allocation from a offshore as well as domestic point of view. As you've seen, interest rates here also are tracking there. So I think it's fairly good, good insights from Ashish, and good work being done by him on the digital and tech front.
Right.
Well
I was watching Masaba yesterday. Masaba, this new show with Masaba and Neena Gupta, right? Where the PR lady tells Masaba that you can't agree with all the other judges. You have to disagree, okay? You have to be a sort of, not only disagree, but also use colorful language to actually go and disagree. So I was hoping that one of you would disagree, but thank you. Thank you very much. You've been a wonderful panel. Thank you so much. And I hand it back to Aditya. Thanks.